Welcome to Poor Millionaires. Today's guest is Graham Rowan. Graham is passionate about financial education and enabling people to take personal ownership of their financial future to create and protect multi-generational wealth. Through his business, Inside Investor Club, he's also on a mission to democratise private equity investing for poor millionaires. Poor Millionaires is a show for people with investable wealth of $1 to $20 million. We strive to educate, connect and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Graham Rowan, welcome to the show.
Thank you very much, James. Great to be here.
So I think it's fair to say that you're pretty much on board with what we're doing here at Poor Millionaires. I saw that you recently published a white paper entitled "I'm a Millionaire, Why Do I Feel Poor?" And that's a great piece. And I do encourage everyone to go out there and find that on Graham's website, which is Inside Investor Club. And we'll talk about your thoughts on the whole poor millionaire phenomenon later in the show. But first, just give us an insight into your background. Because you've worn many hats during the course of your career, haven't you, Graham? Just explain to us what sparked your interest in investing and what brought you to private markets as a particularly interesting asset class.
Okay, well, yes. I mean, one of the benefits of being so old is that I've got a bit of historical context. So I spent the first 25 years in a corporate career, mainly in IT and software. Ended up as a director of a big American company, Texas Instruments. And I was selling multi-million dollar billing systems to telecoms companies around the world as the whole thing exploded in the 1990s with deregulation. And I was making a lot of money, but I didn't really have the time or the inclination to manage my investments. So on the advice of a colleague, I appointed a professional wealth manager, and they put all my money into the NASDAQ. And in the late 1990s, that was quite a good place to be. Every morning, I'd wake up $2,000 or $3,000 richer than when I went to bed. And every year I'd go for a portfolio review and they'd tell me how close I was to my magic retirement figure, however many millions. Then it got to June of 2000, and while we hadn't had any aeroplanes falling out the sky, we had got a slight dip in the NASDAQ, about 10% at that point. And I said, look, I'm no expert, guys, but shouldn't we take some money off the table and do something else here? And they said, don't be such a wimp. Don't you recognize a minor correction in a raging bull market when you see one? We stay in. So I thought, okay, whatever. So I went back off on my travels again, came back in June 2001, by which time, of course, the whole thing had crashed and burned. They'd lost me, I think, about £185,000 in 18 months. And they took me...
Right, that would have been a hell of a lot of money.
Indeed, yeah, this is 25 years ago.
Yeah.
And they took me into a little room and said, unfortunately, Mr. Rowan, these losses take your net worth below the level at which we look after clients. So we're going to have to let you go. So I was fired by my own wealth manager for the mistakes they'd made in my asset allocation. And I was annoyed, I was embarrassed. I had to explain to my wife why we'd lost a big chunk of our savings. But when I reflected on it, I realized ultimately it was my fault. I hadn't just delegated my financial management to these guys. I totally abdicated it. So that was the expensive lesson I learned, that nobody has your financial future at the top of their agenda except that person looking back at you in the bathroom mirror. So I had to take control. That's when I started taking personal interest in investments and went on a journey of reading, seminars, whatever I could get some information. But I was always, the problem is, they'd set me back a good few years. So I felt mentally and emotionally, I was now in catch-up mode. So that started me looking at all sorts of things that would beat the market. And I made some bad decisions, because I was looking for the biggest possible return to make up for this shortfall. And that took me off into things like forestry and care homes and loan notes to property developers, some of which worked, many of which ended in tears. But eventually I came to realize, just really through studying the markets all the time, that most of the value was being created in companies that were not on the public markets. Companies were staying private for longer, and often the founders were seeing an IPO as a chance for them to have a partial exit, not as a chance to access more funding to drive growth, which is the old-fashioned model of an IPO. So it was that made me think, plus even just reading, Robert Kiyosaki's Rich Dad, Poor Dad, everyone thinks of it in terms of real estate, but actually a lot of his big wins have come from private ownership of everything from gold mines to oil wells. So,
Yeah.
and he talks about being on the inside, and that's why we called our organization Inside Investor Club, because you only find these things out through your personal network. So I now spend a lot of my time through what's become a global network looking for the next investment opportunities to put in front of our members.
Yeah, I guess the obvious examples of opportunities like that are things like Facebook, where like the real money was made before the IPO had even taken place, wasn't it? People like Peter Thiel. So let's talk about Inside Investor Club and the 8-figure journey. And you say that your mission there is to sort of democratise private or direct private equity investing. Why are single-digit millionaires, let's call them poor millionaires, underserved by the market, do you think?
I mean, we could talk for hours about this. I think that the first thing I would say is that your average high street independent financial advisor is so restricted in what they can offer. I went to a big advisor event recently because I don't know if you've seen the Capgemini 2025 Wealth Report has just come out. And they've surveyed thousands of high net worth people around the world. And as you know, we've started this enormous wealth transfer from old baby boomers like me through to Gen Xers and eventually millennials. And 81% of these next generation wealth inheritors are saying they're going to change their parents' wealth management company because they were too restricted in their offers and they want access to things like direct private equity. So I thought I'll go along to this advisor conference, I'll talk to some people and say, hey, we can plug a big gap in your portfolio and you can hang on to these clients you would otherwise lose. And they didn't want to know. They were all just running scared from the FCA, and they just said, oh, I'm scared of things like private equity, as if it was some amazing new idea. And yet, if you look back over the years, it has consistently outperformed public markets. And yet, one of the problems for what you call poor millionaires is access, because the big institutions all operate at the minimum 5 million entry level. The IFAs can't do anything for you. So the industry, the financial services industry, has nothing to offer to people in this kind of 1 to 20 million wealth range. But what's also interesting, there's a similar trend happening in the funding of companies, in that the institutions now won't look at companies with an enterprise value below 200 million. So there's a huge gap in companies worth between, say, 10, 15, 20 million and 200. They are now relying on private investors to plug that funding gap when they need equity to grow. So we're seeing higher quality companies coming to us for funding, who previously wouldn't have looked at us. They'd have gone to institutions. So we're actually now, I think, able to punch above our weight and get some really good companies that are already trading, they're already profitable, they just want to go into new markets, build some new technology or whatever. So we're finding really good companies, and then we're finding investors in this 1 to 20 million range who've been starved of access. So there is a lovely kind of sweet spot emerging. And I think as that wealth transfer progresses, people like both of us really, who are both serving this market, will see that more and more people want access to the kind of things that we're offering, whether that's, in my case, private equity, or in your case and Sven's case, the hidden opportunities out there in the public markets, which again, No IFA comes to you with the kind of stuff that you cover in undervalued shares or the weird shit conferences. You know, you've got to go and you've got to really look for these things. So it's this constant search for people who are interested in what we do and who are frustrated by the wider financial services industry because they're not being given access to these kind of opportunities.
So I guess it's one thing investing in a private equity fund where you've got many different companies in there, but investing in directly into individual companies is a bit of a different kettle of fish, and obviously takes a little bit more due diligence. How does Inside Investor Club work? Presumably, you guys have done quite a bit of the due diligence before you present these ideas to your network. So just tell us a little bit about that.
Yeah, absolutely. I think the thing is, there's two aspects to this. One is sourcing the deal flow, if you like, and that is very much where my personal network comes in. I have trusted people that I know if they bring me something, it's already worth looking at because of the more random stuff. 95% of it you could dismiss instantly. I have a kind of a three-tier process with a first stage due diligence, which I can do in probably about half an hour. And that decides whether they get to the next stage, which is a bit more detail. And finally, if I really think it's something I'm going to put in front of members, then I'll go into the third level of due diligence, meet the founders, go through a virtual data room, all the accounts, pipelines, people, etc. But we are not advisors. We cannot tell people what to invest in. So we always say, here's something we think is worthwhile for you to look at. You must do your own due diligence. If you do an NDA, you can get into the data room and see everything we've seen. If you want to go and meet the founders or have a phone call with the founders, we can arrange that. But ultimately, you must make your own decision. So one of the reasons I introduced the 8-figure journey, that is a coaching and mentoring program, because obviously not everyone that comes along is experienced as an investor, or they've always relied on advisors or whatever. So we want people to be comfortable and confident about what they're investing in. Otherwise, they won't do it. So we always recommend that you have a bit of coaching and mentoring first. And then even if you do a kind of a dry run, do the due diligence on a few of these companies without making any investment, just to get practice at it. And then only when you feel confident, then make an investment. Because typically, the entry level is around about $50,000 or pounds. So it's not trivial, it's not crowdfunding. We're coming in, typically we would raise anything from 1 to 3 million for a company. And usually the entry level is about 50,000. The average among our members is about 100,000 that they invest in each opportunity. But, you'd only do that if you were comfortable. So, yeah, the funds are all out there. You can go in, obviously, anything from sort of 10,000 upwards into the funds. They will have a much wider spread, but equally, that will reduce the return because you're taking an average across them all. We are not suggesting that. We are, again, if I can use another Robert Kiyosaki term, he talks about diversification. Even Warren Buffett has a similar idea of putting a small number of eggs in the basket and watching it closely. And we do believe in concentrated portfolios, not in scattergun portfolios. And one of the things I think investors have to come to terms with is that while the last 10 years have been great for passive funds investing across whole markets, I'd be amazed if the next 10 years provide that level of performance. I think we're going to see either flat or declining mainstream markets. You're going to have to go looking for performance in the same way that you guys do. So we're looking for companies that can grow 5x, 10x, 20x in the next 5, 6, 7 years. And so it's things that will really move a dial on your portfolio. If you look at, for 100 years now, the S&P has given you 7% a year, which is great. If you compound that across the decades, you'll get to a decent figure. But if you're like me, and I think like quite a few people in their perhaps 50s and 60s, if you feel you're behind the game, if you feel you've got some catching up to do, 7% is not going to do it. So you've got to find something that's going to turbocharge the portfolio by giving a part of it, and typically we talk about 20, maybe 25% as being a maximum allocation in your portfolio to private equity. But if you take 20%, 25% of your portfolio and start getting these kind of returns, then between your current age and say the next 10 years, you can make a massive difference to where you're going to end up in terms of net worth.
And in terms of sort of sectors, is there any areas in particular where you're kind of focusing your attention at the moment?
Not deliberately by sector, but we do look for certain characteristics of companies that are going to grow fast. So we tend to look for, firstly, are they solving a real problem in the real world? This is not some idea dreamed up in some university lab somewhere. But secondly, are they solving that problem with some technology or unique intellectual property or tech of some kind? Because usually it's the deployment of technology to scale that's going to give you that multiplier effect on the value of the company. It's much harder for a services business to 10x in 2 or 3 years because they haven't got enough people. But if you've got a platform that is new and different and is valuable, then that's the sort of thing that can grow. So we've done fintech, we've done aerospace and defense, which has turned out to be very timely and very appropriate. We have done a digital inheritance platform, which is a very new, unique thing. Because, for example, I went to one of the biggest will writers in the UK and said, okay, you got all this stuff about my property and so on. What about my Bitcoin? What about my digital assets? What about this digital art and so on? What? Can't help you, mate. So they just aren't geared up for it. So we found a company that's doing all this kind of digital inheritance stuff, and that's going really well. AI is a tricky one. Now, everyone's talking AI at the moment. I'm really nervous about investing in a single AI company because the technology is moving on so fast that I think you could get a great story today. You put your money in, 6 months later, it's been completely overtaken by some amazing new ideas. So on that front, we've actually backed a company that's working with 75 different AI partners, and they are the kind of not exactly system integrator, but they are the experts who would go into a big company and most big companies are totally lost, by the way, about what to do with AI. They'd look for the opportunities and then they'd bring in 1, 2, 3 of these other companies to help solve those problems. Now, they won last week. They won a $5 million contract. This week they won a $7.5 million contract. So they're busy. And the OpenAI that actually developed ChatGPT, they've just announced that they're going to go into this high-end consultancy business, but they won't get out of bed for less than a $10 million project. So that's completely validated these guys' business model. So we're always looking for things like that. Geographically, most Western people have very little exposure to Asia. Huge growth going on in Asia at the moment. So we have a Singapore-based company that's investing in companies in Singapore and India where there's massive growth going on. So again, because they're a top co with fund structures underneath, we're benefiting from, I think, there's 37 companies in the portfolio at the moment, and they're adding to that all the time. So they have both an investment model and a kind of advisory sweat equity model. So if they see a company that needs help with marketing or distribution or back office, they put people in, they charge a mixture of cash, fees, and equity. So they end up owning a stake in some of these very promising, fast-growing companies. So we're looking for those kind of characteristics. Is it a sector like defense that's going to be really hot? Is it something like AI, but without the risk of an individual company? Is it in a region where most people might be underexposed? So those are the sorts of characteristics that would drive the choice that we make. And at any one time, we'll only have 2 or 3 things in the portfolio. And really what we're saying to our members is you probably only need to make 5 or 6 decisions here. We're not suggesting you invest in 100 companies. We're saying you invest in 5 or 6, and then hopefully at least a couple of them will really shoot the lights out. A couple of them will perform well, okay, and a couple will underperform. Maybe one might fail completely. That does happen. So as long as people go in with their eyes open that they're going to have a spread across 5 or 6 companies, and they can take a 5, 6, 7-year view, then they can start to see these 5, 10x multiples that are going to make a difference in their portfolio.
So if I'm a poor millionaire, I'm looking to dip my toe into this market. what should I be thinking about when I'm starting out, and what are the most common pitfalls for investors in this area?
I think really you've got to first of all, you've got to be interested in the subject. I think it does help if what the company does, there's always a little bit of an emotional connection, that you buy into it because it's whatever in that sector or that area. But then you've also got to look at, do I believe in the founders? Do I think they are the people that are going to deliver on this plan? Because you can be in the right sector with the right idea, but for example, I found that people who come from a big corporate background often don't really have that entrepreneurial spark that you need to build something from a very small company into hopefully a unicorn. So the people, ultimately, I keep saying this, you're always investing in the people. Yes, the technology is important. Yes, the business plan. We all like to see nice business plans with great big, revenue and profit growth. Every pitch has that. But do I believe these guys can deliver is the most important question you have to ask. And that's why I always want to kind of see the whites of their eyes. I want to see the strength of their handshake. I want to look at what they've done before putting them forward. So I think ultimately the lack of due diligence, it would be a very high level way of saying the biggest pitfall for new investors. But I would say, take your time. We've got people who join the club and don't make an investment for 2 or 3 years. They just absorb the content. They come to our events. They meet other people. And don't underestimate that, because I know it'll be the same in your community. Most of these people's friends and families are not interested in investing at all. And they think they're a bit weird, these people. But when you get 100 of you in a room together, it's the most amazing vibe, because where else are you going to meet people like this? So the live events are great. You get the content, watch the webinars, gain that confidence, do a bit of research yourself, and then when you feel comfortable, start making investments. Don't feel, we're not a hard sell organization. We're too small for that. We just say, look, take a look at this, see what you think. Here's what we like about it. Here's what we're not so sure about. Overall, we think it's worthwhile. And just to be clear, we take a decent chunk of our own fees from the company we're raising the funds for. So we have equity in the business. We go on that journey with our members. And because it's the company that's paying, that's why we don't need to make membership charges or investment fees. So, it's free to join as long as you qualify under the FCA guidelines for being high net worth. We just ask you to do a little application form and a self-certification, and then just absorb the content. If you want to do the training, that's an option as well. And then invest when you feel ready and confident.
So I guess one of the obvious downsides of investing in private markets is the fact that there's no secondary market, so the liquidity issues. So if you're investing in a private company, you're going to be locking your money away for an indefinite period of time. What would you say to investors when it comes to managing these liquidity risks in private investments?
A couple of things on that. First of all, yes, you must come into it with a mindset that this particular amount of money, and as I say, it's only 20% of your total portfolio, is for the long term. And it's no different, say, a lot of our members, for example, are big property investors. Well, you invest in real estate. That's typically a 5 to 10 year view, and your money's tied up. Now, okay, you might get some rental income from it. You tend not to get dividends from the fast-growing private companies we invest in. So it's not an income play. It's a big capital gains play, which is why things like the enterprise investment scheme are so attractive, because after 3 years, you don't pay any capital gains, and after 2 years, it's out of your estate for inheritance tax. So if you can find a fast-growing company kept within a tax wrapper like that, you can maximize your gains. There are some opportunities for liquidity earlier than perhaps an IPO or a trade sale. For example, as companies grow to a certain size, the institutions start getting interested again. And when they come in, one of the things they like to do is clear up the cap table and get rid of all these small investors. So we've got a situation happening now where people who invested just, I think, 2 years ago are going to have an exit at a 4x, a 400% uplift, because a family office is coming in, making a big investment in the company, and they want to take out some of the poor millionaires, as you call them.
Poor millionaires.
So those poor millionaires will have a 4x uplift, which is quite good in 2 years. Also, there are increasingly secondary markets emerging. There's one in London called JP Jenkins. I think there's one now that I believe has been set up in Gibraltar. So there are increasingly secondary markets, just as there are for the big funds now. So people have recognized that long-term tying up of money can be a problem for people if their circumstances change. So we're seeing a bit of a move towards secondary markets. And I think they're a good opportunity, because it means you could get in when, let's say, the company had already gone 3 years down a 5-year journey. So you can come in and, yes, you'll pay more than this guy did 3 years ago, but you're also that much closer to an IPO or a trade sale. And increasingly, by the way, it is strategic trade sales that are the exit rather than IPOs. And if anyone's followed the London market, you know how few IPOs there are these days. So usually it's either a big private equity firm that might come and buy the company, or a strategic buyer that's already in the same sector, wants that technology or wants that client base or whatever. So most of the exits we're seeing are not IPOs, they're trade sales of one sort or another.
And let's talk a bit more about the EIS scheme, and there's another one, isn't the SEIS? So these are quite generous tax incentives in the UK for people investing in early stage companies. Obviously, American, European listeners might want to skip over this bit, but just tell us a bit more about those schemes and what the specific benefits are to investors.
Yeah, sure. The seed enterprise investment scheme tends to be for very early stage companies. So although it's more generous, it's not something we would typically use, because we want the companies to be a bit more mature. But the idea is, firstly, you get an upfront refund of income tax you've already paid. On the seed model, it's 50%. So if you were investing 100,000 in a private equity firm under the seed scheme, immediately 50,000 of that is reclaimable from your income tax. If you're going for the EIS scheme, for the slightly larger, more mature companies, you're still getting a 30% refund. So your 100k investment is only actually costing you 70k. And then within 2 years, those shares are outside your estate for the dreaded inheritance tax, which of course Rachel Reeves is hiking up all the time. After 3 years, they're out of capital gains tax. Now that benefit might become even more substantial if the rumours are true about the October budget aligning capital gains and income tax. So those are nice. And then there's even downside protection. So if it all goes pear-shaped and you lose your money, then you can also reclaim, offset the losses against tax as well. So your actual exposure is probably more like about 50-60% of your initial investment. So you've got all the upside tax-free, limited downside, and it is, I think, one of the best schemes in the world for encouraging investment in growing companies. Still not that well known by the average poor millionaire, but certainly something that if we can get EIS, we always go for it. Sometimes companies are just already too big or too well established. They have criteria they must meet about their size, their balance sheet, etc. And if they're too big, they don't qualify. Most of the companies that we get involved in are bigger than seed EIS, but they're fit still into the EIS model, which is the sweet spot for the good tax benefits, but also we mustn't let the tax tail wag the investment dog. We really want a good company that's already proving itself in the market. If we can put that into a tax wrapper. And the other thing people sometimes use, by the way, a lot of property investors have a SAS pension, a small self-administered scheme, and you can also oftentimes invest in private equity companies through a SAS pension. So if, for example, there was a company that you liked that did not qualify for EIS, but you have a SAS pension, you can invest through there, and all the tax breaks of the pension would apply to the shares.
So, how does direct private equity fit into an overall investment portfolio strategy? How does it complement the other assets in the portfolio? Because obviously, as a poor millionaire, I'm not going to kind of throw all my money into direct private equity because I need the liquidity. So, how do we kind of navigate that? What's the sort of the optimum sort of allocation, for example?
Yeah, no, we have a kind of model portfolio that we share with our members where we talk about potential asset allocations, and most people have got some sort of property in it, real estate. Most people have got some exposure to the public markets, whether that's through ISAs or SIPs or whatever. We encourage investment in things like Bitcoin. We think that's an asymmetric risk in terms of where it's going as it gets more mainstream. But yeah, we try and learn from billionaires because what I always say is you don't have to be a billionaire to think like one, and they're often the best advised people on the planet. So recently, for example, I looked at an organization called Tiger 21, which kind of picks up where we leave off. The entry level of Tiger 21 is a net worth of $20 million, which is kind of the upper end of the market we serve. They have their own asset allocation based on what all their members are doing, all their super rich members around the world. And they've got 28% in public markets and 28% in private equity. The Goldman Sachs Family Office Survey from 2024, I think they showed there was 26% in private equity, and that was split more or less equally between funds and direct investing. So we would recommend something in the region of 20%, but spread across five or six companies. So obviously if you've owned, depending on the size of your portfolio, if you're at the 1 million level and we're talking about 50k a time, then you might only do one or two. If you've got a 5 million portfolio, then you'd have no trouble doing 5 or 6, as we suggest. So probably circa 20%, working up to it over a period of time, but no more than that, with a view to this being the juice, the superpower that needs to really give you some movement on the portfolio value over the next 5 to 10 years. That's what we're trying to achieve here. It's not get rich quick. It's not an income product. It's choosing a handful of companies that are going to 10x in value and make a big difference to your portfolio. That's the goal with what we're doing.
One thing I want to get your opinion on, Graham, because the private equity has had a lot of interest recently, over recent years. I just wonder, has the pendulum swung too far in favour of private equity? Because a lot of private equity funds, for instance, have suffered quite recently. Obviously, we've had interest rates go up quite a lot. So the gravy train is not sort of running, so to speak, in terms of the cheap money anymore. Have investors as a whole become too obsessed by private markets, and are they kind of neglecting the public markets?
I think there's a fundamental difference between what the big private equity firms do and the way we approach this. What they've always historically done is to use as much leverage and as little equity as possible. So for them, the viability of a deal, and leveraged buyouts would be the obvious example here, is all based on how much the debt's going to cost. Because what they want to do is buy an operating company with a load of debt, use its profits to pay down the debt, which automatically increases the equity value. So they want to put a thin slither of equity in, massive amount of debt, and then just basically operate the business as normal without even improving it, and you're going to make a big difference to the equity part. We don't do that. The companies that we go into often have no debt whatsoever, and we're not providing debt, we're providing equity. So we are coming into typically much smaller companies than they would target, at a point in their growth where that money, that million or two, will make a real difference to how they can grow. So yes, the big private equity funds have struggled with interest rises because they can no longer play their financial engineering tricks with leveraged buyouts. And they're struggling to get exits because they are just managing their debt piles. We're in a different game to that. We're using smaller companies at a different point in their growth. So yes, they have struggled. To answer your question about is it overexposed, I think our kind of private equity is still a well-kept secret. I think, if anything, investors are overexposed to passive investing through ETFs. And the inventor of passive investing, John Bogle at Vanguard, he only ever wanted this to be 20% of the market. Once you get more than 50% of the market in passive funds, you don't have a market anymore.
Yeah.
Who's on the other side of the trade? So we're in this very strange position now where, and this is one of the reasons the Magnificent Seven have done so well, is that all these funds, and there are many more funds than there are individual shares to invest in, all these funds are buying the same companies, which reinforces their share price, which reinforces more funds coming in. And so you get this terribly concentrated market where seven are going gangbusters and 493 are zombie companies. So those markets to me are far more dangerous at the moment than private equity. And where there have been sales of private equity firms out of the funds, they've tended to meet or exceed the net asset value at which they were being held. So it's not like they're overstating the value, even though there are, I know, some discounts to the net asset value in these funds. That's more reflective, I think, of the difficulties we were talking about with interest rates and so on. So it's not that the companies are overvalued. We have a different model to the big funds. It's just, frankly, a well-kept secret. And again, I come back to the point. This is where, if you said, what's our unique selling point or whatever, it's access to the right opportunities. And that's at a very personal level. That's at a personal network that I've spent 15 years building. And there's no really easy shortcut to that. So that's kind of where the value comes, is from seeing things you're never going to hear about from your high street advisor. You're not going to hear about this through any other source. So you need to be kind of a part of the club to get access to these kind of things. That's really where the value comes from.
So I want to move on to the why behind all this now, Graham. So why should someone aspire to have a net worth in the eight figures? What's driving them? Why do they even need an eight-figure net worth?
Well, but I think part of the answer to that is in the name of your own organisation there. Being a millionaire is not what it used to be.
I mean, I've got my own answer. I'm just interested to hear yours.
No, I think, well, firstly, just quite simply the value of money. What we're seeing now is massive debasement of currencies. People tend to focus on, 2 and 3% inflation targets, but over the last, 20 years, probably arguably since 1971, when Nixon took the dollar off the gold standard, fiat currencies have been declining in their spending power. Most of them have lost 95% in that time. So if you were a millionaire in 1971 and you kept all your money in the bank, you'd be lucky if it was worth 50,000 today. And that's wealth destruction on a biblical scale. So one of the things you talked about in my white paper earlier on, one of the reasons I think we do feel poor is that on paper, my house may have gone up from 100,000 to 1 million. But what's really happened is it just takes more of these pieces of green toilet paper called pounds or dollars to buy the same amount of bricks and mortar. And if you value your house in ounces of gold, for example, you'll get a very different view. So part of it is wealth protection. We need more money just to have the right kind of lifestyle, and things are way more expensive than they used to be. Part of the reason for doing this, and I do believe we need to become kind of sovereign in the way we manage our affairs. And there's a reason why I'm talking to you today from here in Portugal. I've been here 4.5 years now, and I came for two things: more sunshine and less tax. So I have a non-habitual resident scheme where I pay no tax on foreign dividends. So for me, that really works because most of my income is through my companies. But there again, these things change all the time. That scheme is no longer available. So one of the things that I encourage, and I just launched a new newsletter called Escape Velocity, which is all about building businesses, first of all, that throw off cash, using that to build an investment portfolio that will include the kind of things we've been talking about, and then the combination of those funding both the lifestyle that you want and also the legacy you want to leave behind to your family or whatever. Because I'll get on a soapbox if you're not careful here, but I do believe our fundamental freedoms are under threat like never before in my lifetime. Now, I'm one generation away from World War II. My father was on anti-aircraft guns in the Second World War. Now, if I could bring him back to life and say, Dad, by the way, that country you fought for and risked your life for back then, you can now be imprisoned for sending a tweet in this country. He would just be totally shocked. Is that? I thought I was defending us from that sort of thing. These things are. I don't understand why there aren't more riots in the streets about this. The freedoms that are being taken away from us. If anyone would like to go further on this, I'd recommend going on YouTube and searching for a documentary called The Agenda, and you'll see what's going on in terms of global government, in terms of central bank digital currencies, which really will be digital slavery. So part of my motivation for all this is paranoia about what they are going to do. And I think actually a bit of healthy paranoia should be in everyone's toolkit. Maybe maybe you're not as extreme as I am with this, but I certainly
I think we're very, very well aligned on this matter, Graham.
Well, yeah, and
I think it requires a whole separate podcast, maybe several episodes. But yeah,
no, absolutely. That's why I've started, as I say, the Escape Velocity newsletter, which is on Substack if you want to go and subscribe. But it's a project. It's not an event. You've got to start. What I encourage people to do, just start doing some research. And also, I encourage you to use. There's a guy back in the 70s called Harry Schultz who came up with what he called a 5-flag theory, which is a way of thinking that you might want to place yourself, your family, your lifestyle in one country. You might want to place your business in a different country. You might want to hold your wealth and your portfolio in a third country, and you might want to have another passport or residency somewhere. You need to think about, for each of these aspects of your life, where can I be best served? And I would say that, for example, in the UK at the moment, if you're an entrepreneur or an investor, you are not being well served with record high taxes, with very anti-business agendas and so on. So you've got to start doing the research first of all, and then start putting the pieces of that jigsaw in place. If you feel like I do that we are under threat, personally, I feel now it's almost gone beyond the ballot box. I think we're at the kind of fight or flight stage, and I've just voted with my feet by coming here. So, I've walked my own talk. In fact, back in 2018, when it looked like Jeremy Corbyn was going to get elected, we went and bought a property and got residency in Montenegro in Eastern Europe. Lovely place, but we felt it was it's a developing country. It's not a developed country. So we didn't feel it was a permanent home. And, then we came to Portugal. But you've got to start looking at these things now, even if you think you're 5 years away from doing anything. The time to begin is right now. And I would also encourage you, a lot of people say, oh, I can't leave my family or my children or my parents. Well, take them with you. I mean, don't let that stop you. Don't let that be an excuse, because we're under threat like never in my lifetime. I'll be 70 next year, and this is just unprecedented. I think we can all agree that the current government is incompetent, but they're also, very Marxist and very totalitarian in their outlook. And 4 more years of this, I shudder to think what Britain will look like. So, and even, if you're in Europe, there's various challenges for the, people watching us in America. You've got a different set of challenges. But, you've got to take control. You have got to be sovereign master of your own affairs. And the time to begin that is today, not some distant time in the future.
So become a sovereign individual. That's today's message.
Absolutely. But to do that, you need money. And I think you should be targeting something in the region of a 10 million net worth to get you there. If you're already at that level, great, you can start implementing your plans. But I think trying to do all this stuff on much less than that is a challenge. So, that's why I talk about business, I talk about investing, and I talk about, the sovereign lifestyle stuff, because they're all intertwined and intermingled. And you need a plan and a solution that addresses all three of those aspects of your life if you really want to end up on the right side of history.
Graham, it's been an absolute pleasure. Thanks so much for coming on the show today. And I wish you the best of luck with Inside Investor Club. Just tell our listeners any other channels that they might need to be aware of.
Yes, certainly. InsideInvestorClub.com is the website. You can fill in the form there and join. It's free of charge. The Escape Velocity newsletter, you can subscribe to that on Substack. And then just connect with me on LinkedIn. You'll find me under Graham Rowan 1, I think it is, or 4 on LinkedIn. Just connect with me there, and it'd be great to have a conversation.
Thanks again to Graham for his time today. You can follow Graham's work at InsideInvestorClub.com, and you can also listen to his podcast, Diary of a High Net Worth Investor, on Spotify. Don't forget to like and subscribe if you enjoyed the pod, and thanks for listening.